all bets are off as you approach early September and have that risk of that early frost event.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. We love talking with you about our ag markets and ag issues. And well, today is no different. Before we start, I want to remind you, make sure you like this video, subscribe to it by clicking on the bell icon below, and share this video with others as well, as we continue to become one of the fastest growing ag podcasts out there with your help. Today, I want to call on Joe Camp of Comstock Investments. We'll take a look at the midweek markets here on a Wednesday. Joe, I'm looking over here at our closing prices from today, and that's a switch. A lot of green on the screen. It seems like everything is green except for maybe crude oil for the energy markets and cotton. Other than that, everything had a fairly positive day. What happened?
That's right. The grains and livestock higher on a what I'd call pretty quiet session. Some spreading was key here today. Some of the more heavier volume proportions dedicated to, say, getting spreads rolled out. September, December corn actually reached a new low for the move. We're talking about out to, almost any semblance of a calculation of full carry here. And it tells you something, of course, about the market structure when you're looking at these spreads offer that carry incentive, saying we don't necessarily need it now. We'll pay you to wait. We know a new crop's coming along soon enough. In some sense, we know regionally basis and trying to get some coverage for the rest of this window before the new crop would come. In some areas, maybe later than normal. That's still the case, it's going to be. But in general, these spreads in the futures market, extra wide carry levels historically here to look at, and so that dominating some of the activity in what was, again, a pretty quiet session.
When I look at the close, though, let's talk about the grain side here. It didn't seem to be anything overwhelming. I didn't see anything that really jumped out as far as any kind of fun short covering yet. I would think if they were doing that, you would see bigger moves, wouldn't you?
Well, you would think so, given that the funds had reamassed these record net short positions last month in corn and soybeans. The flip of it, though, is if we go off of what we observed in last week's report, they go through Tuesday of each week, but there was substantial enough, you could call it, more than 50,000 contracts worth of corn futures and options covered on that last reporting week. Yet the corn market only bounced 8 or 9 cents over that time frame. And so, unfortunately, we are still in an environment where fund short covering can be absorbed at a relatively reasonable pace by farmers selling on the other side. And so there has been anecdotal evidence as we talk to farmers, as we hear from commercial managers out there, that the corn is still moving here, even at lower levels, as farmers work to get ahead of the next harvest.
Well, the old saying is never try and catch a falling knife. But boy, it sure is tempting when you look at corn and soybeans that, they are so oversold. People keep thinking, oh, the bottom has to be closed. But then they've been missing it for about a month now.
That's right. And that's a pull between the short-term and the long-term perspectives, as always. In the short run, it's just a reminder of how quickly we've come down over the last several months, and how we've broken down to new lows that on the long-term perspective maybe look a little bit differently. And that's really what gives us caution. If I could show you a long-term graphic here for corn and soybean prices, we're looking at soybean prices up there in the green, elevated relative to corn futures in the white, the nearby contracts, and showing us what's at risk if chart lows from 2019 or 2020 are going to be tested. And really, we've been talking about those levels because you can see not much else on the charts, unfortunately, below these current lows that would be technically supportive potentially until you would get down to these levels. Now, before that, we've identified some different levels, certainly $9 even on soybeans, even down to $3.75 and $3.50, those even quarter increments on corn. There can be Fibonacci projections. There can just be psychological buying interest at those levels. But we can see that for soybeans, it's all the way down to just below $8 in 2019, and for corn, it's $3.25 from early in 2020.
Now, in case our viewers out there can't decipher the detail on that, maybe you can bring that back up again. Just wanted to point out on the upper part of that graph, that would be in the green. You're taking a look back. That's a soybean line going back how far?
Yeah, those are soybean futures going back to just before the start of 2019. So we are looking at the previous roughly 5 years, and can see that we're now down to basically 4-year lows and not much under the market yet before those real big bottoms from before the pandemic, before interest rates started moving all around, before so many factors, inflation, importantly, drove a lot of so many markets higher. At this point, that's the risk, the downside. But then we're going to be wondering about those things. If the grains are returning to pre-pandemic levels, where's the rest of the commodity market? Where's inflation in general? Certainly, where's cost of production, and what does that mean for the long-term projections?
Now, of course, the green is the soybeans, the long-term chart here, and the white horizontal line at the bottom of that green graph would represent the multi-year low that was established back then. Now, the corn is the white line, the white jagged line there, and there again, the white horizontal line at the bottom of that would be the long-term low. However, I see they didn't occur at the same time, did they?
No, they didn't. There was some divergence. We can see how closely they generally track with one another. At this point, they're somewhat similar, even though the low for soybeans is 2019 and the low for corn 2020. They're both roughly, nearby futures are about 20% above those lows. So, if you're measuring risk in terms of further downside percentage, that's what's in store here. 20% down to these lows, respectively, both corn and white there, and soybeans in the green, and some other key considerations like if soybeans were to drop below down to their 2019 lows, we can see they'd be under the peak of where corn was at its highs just a couple of years ago. And that's why we look at it from these larger term perspectives. We can just see where we've been and what that might say for what's ahead.
So, with that in mind, even if we did get a bit of a bounce right now, Joe, you could actually have both the corn and soybeans make a fairly significant upward correction. I'll put that in air quotes, a correction, and still not violate the continuing downtrend line, right?
That's right. It takes a lot to buck this spiral that's developed, the bearish primary trend, any way you look at it. But it can be something where you have at least short to intermediate term considerations of what bounces might mean, or even retracements for selling opportunities as we get that back to our work with farmers and trying to hedge ahead here for new crop in particular. The conversations, of course, so many are about right now. So downside risk evident here, but if we go back to the conversation about where speculators are positioned as short as they are, if they can start to buy back these futures, if they have a reason to do so, and they are interested in covering at a faster pace than farmers are eventually interested in selling, then that's what can produce a more significant price bump than what we've seen lately.
The only hard part about trying to stage a rally or a correction upward again at this point, harvest is really starting to get underway in a big way in the South. And I mentioned earlier this week that where I'm located in northern Tennessee, the crop is already starting to turn, indicating that it won't be too long before it dries down for harvest here. If that's the case, I mean, there's a lot of corn in the Mid-South area here and in southern Illinois. We're not looking too far away. It's going to be hard to rally at that point, isn't it?
It will be. Always seasonally, you're going to think about the potential for harvest pressure. Where you gauge it in terms of what degree it might or might not be, that heaviness that's applied on the market when you just simply have bushels being sold across the scale, certainly in many cases. But you do wonder the aggressiveness of farmers that are going to be selling early on in this harvest. We also want to see about the window of harvest relative to it being drawn out or not, which can be the case as we've had when you have lumpy or extreme planting windows like we did this season. If you can have an early crop and a late crop, do you avoid sometimes getting all of that biggest peak rush across normally the Midwest and that early October timeframe, whereas that's just an insurmountable weight on the market. If it's more drawn out, potentially you have less of that. And the other thing that we'd keep in mind is that harvest is going to coincide with a continuation of the reporting cycle. So USDA and what we learned earlier this week, it's about proving that or not. And if it's the case that, well, we're pulling in really good crops, but it's not quite the records that we've reached, say, this month, or even if we go higher again going forward into September, if eventually we've got some tempering of the enthusiasm for this crop size, that could be what helps us put in a harvest low or gets us close to avoiding one.
Do you think the market has even just a little tiny bit, just a little bit of weather premium built in for just that slight chance of an early frost in the northwestern Corn Belt?
Well, not yet. If you look at new lows and new lows, you'd wonder about any attention paid to that. Now, it's a conversation I had just this morning, talking, with a farmer in South Dakota, knowing about where North Dakota, for example, could land, about crops vulnerable in Minnesota and in so many places, given that we've already had this taste of fall in places with the cooler temperatures going against, of course, what had long been this call for such a hot summer. We do have the 2-week outlook shifting back mostly warmer and drier, but all bets are off as you approach early September and have that risk of that early frost event.
Well, what else jumps out at you to get your attention here on the grain markets right now? What are you watching?
Watching for demand. We keep talking about it, whether or not these lower prices are going to beget better buying interest. There have been some signs of that with flash sales popping up, talk about China's buying this or China's buying that. There is reason we should believe that there's going to be a positive response to the recent price break for corn and soybeans in particular. Wheat, you could say that for as well. But for corn and soybeans, as we head into the new crop and want to start seeing these export commitments being booked in a bigger and bigger way, there's the potential that we're going to have more and more and more of that, and that will actually disprove a lot of these worries right now that China's not going to be buying anything, that the global economy is suffering, and that we've just got too much to go around. In fact, demand, both on the export level and the domestic side, feed and processing, can really spark this low prices are the cure for low prices type of turnaround eventually.
Last I recall, the U.S. soybeans, for example, were way overpriced compared to our South American counterparts. And a lot of that had to do with the currency exchange rate, if you will. And I just wondered, has that changed much? How do our soybean prices compare on the world market now to Brazil?
Well, I do have a graphic that I was looking at to that point here. It's because of how we are monitoring demand and this interest potentially at lower price levels. And so I'll have this big white graphic, wash me out, but to show you levels of soybean prices, export offers for the U.S., Brazil, and Argentina. Of course, they're big competitors. We have these in a dollars per metric ton basis. But finally, this U.S. line, soybeans from the Gulf in blue, has dropped below both the green and the orange lines. That would be Argentina and Brazil prices there. Now, that's in part currencies that you bring up that have been so important lately. We talked about what broke the stock market and the involvement of the yen carry trade with investors borrowing yen and then using those loans to buy currencies like U.S. dollars and then put them in assets like U.S. equities. And then the unwinding of that occurring as the yen rises. Well, we'll watch the yen certainly because the Japanese are a big buyer of our grain exports. And if their currency is moving higher against our dollar, that bodes well for their purchase interest. And we can also see that as the dollar weakens against the currencies in the hands of our competitors like Brazil and Argentina here, it improves our terms of trade for exports. And when you also have the board falling lower like this position, the U.S. beans below South America in some regards, as shown here by the International Grains Council, that's a positive for demand going forward.
Well, I wanted to ask you about the solid close we had on the livestock trade. Here on Wednesday, have livestock finally established a base now to move up from or not?
I would believe so, that we're shaking off the knee jerk, the nervousness, that big link we observed to the stock market selling off for 3 hard days and bringing the cattle down right with them. We looked at in the Comstock report. We looked at on one of those stock market sell-off days the S&P futures right alongside the live cattle futures, and they were right in sync, basically on a nearly minute by minute basis, to bring in that worry about the global economy and to relate it to how speculators in the live cattle too were just wanting to rush for the exits and get out of a market that had offered profitability for the most part in their positions, having been built that way. But now we're back to the fundamentals and thinking, where is cash going to land, and what does that mean for board prices, especially as the August contract heads into the delivery period. So if I can just show one more chart here, it'd be this August live cattle chart. You've got the prices in the white and the Bollinger Bands that we talked about for volatility, split by the 20-day moving average in blue, which we can see really resisted the upside move today. So we're back testing the bottom end of that broader upside channel, the middle of the Bollinger Band range, and going to see here the rest of the week if we've got that follow through to resume what has been that bullish trend over the past several months, and one that's still fundamentally, as we would call it. We look at the cash market too, again, relative to where the August is, as it heads towards expiration at the end of the month, and there's going to be an issue of convergence as well.
Interesting stuff. It seems on that chart like the live cattle like to move up in like 3 or 4 cycles at a time before they have a correction. I don't know if that's a normal pattern or is that just unique to this year.
Seems to have been more so as of late, and we can see these pushes up, oftentimes also followed by the most recent 3 hard days down, a little bit of consolidation, and then outright worry and liquidation. Like with any market, though, you clear some of the speculative interest, and then you look around and adjust for the fundamentals, which in the case of the cattle futures here these past couple of weeks now have adjusted more favorably towards the upside.
Well, the feeder cattle chart looks a little different. They had such a steep sell-off here, and then it looks like they're maybe consolidating a little bit here in the last week or so. Do they have much guidance there?
Well, wondering if they have any guidance from corn. So, monitoring that potential carving out of a short-term low. But quite simply wanting to see if this cash market stays as elevated as it has been. If that's going to be the case, then it is the fact that feeders are lagging the live cattle and would have, for that reason alone, some interest in potentially catching up here going forward. But the feeders, just like the live cattle, they're all going to depend on not having these big economic worry, these injections of risk off come into play. And unfortunately, I'm not ruling that out the way these outside financial markets look and the way we have these readings on the economy.
Did hogs have an outside update today on Wednesday?
I believe they would have after this reversal. I'm seeing the October contract did not. So not on a daily basis, but it did hop back above some key support points. Yesterday's recovery made it hard to poke down to a new low, it would seem, this morning after they started, but then built some steam. Maybe a bigger turnaround. We saw some slight strength for the pork cutout back above 100, some early week stability in the cash hogs, but this seems to be more of a speculative push and technically something that supports maybe some follow through.
At the chart I was watching on that same contract, Looks like it is testing the 50-day moving average, and it's done that twice in the last month, and it failed both times. It sold off again. This would be the third try. If it stays there for a couple of days, that would bode a little favorably, wouldn't it?
It would. It would be potentially a reason for some of those speculators to jump back into the market based on what their computer algorithms say they should be doing after having liquidated, of course, their bullish bets in the hogs over these past couple of months. Now that the position managed money basically even that market, they would have room, it would seem then, again, barring any real big recession fears, anything else that pops up, you would expect the fundamentals to be something that could also pull the speculative interest towards some buying again.
And I've heard some analysts refer to hogs or pork as the recessionary meat. So we'll see if that actually comes into play or not. Hopefully that won't be necessary. Joe, thanks for talking with us once again. Always good to get your expertise. I appreciate that. Joe Camp of Comstock Investments. That's going to do it for this episode. Thanks again for joining us. For producer Brianne Hendrickson, I'm Marlin Bohling, and we'll catch you next time right here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.